Hi everyone, welcome back to Corporate Decoder. Today we are diving into BigBearai's latest quarterly report, so fasten your seatbelts, or should I say, engage your neural networks, because we're about to decode some corporate intelligence and hopefully I can make it interesting enough so that you don't fall asleep after 5 minutes. BigBearai's is, well, a bit of a mixed bag. It looks like they are raking in some serious cash, but also burning a lot of it too. So what's really going on beneath the surface? If you appreciate getting straight insights from corporate documents, make sure you're subscribed. We also have a Discord community linked in the description below for more discussions about all this business mumbo jumbo. First, let's talk about cash. Cash and cash equivalents shot up from $50 $1 million at the end of last year to a pretty impressive $1.7 million. That's a huge jump, suggesting they're doing something right, but remember to look at both sides of the story. Now, their accounts receivable, the money owed to them, actually went down a bit from almost $39 million to around $34.6 million. This could mean they are getting paid faster, which is always a good sign for business. Let's look at how they did this past quarter. Their revenues went up slightly from $33 $1 million. On the one hand, that looks good. A lot of companies would love to make $35 million per quarter. But if you take a step back, you'll notice their expenses are eating up most of those gains. One thing that's really different this year is, unlike last year, there were no big write-offs due to goodwill impairment. That means last year they had to admit that they overpaid for some assets, but this year things are stable, at least on the surface. Here's the part that might make you raise an eyebrow. Their losses are still huge. They lost $0 and $20 20 AT lost last year, but they're still far away from being profitable. It's important to remember that a lot more shares were outstanding this year versus last. Last year there were 187 million shares outstanding, but this year that number ballooned to 252 million shares. That means every slice of the pie is getting thinner and thinner. Switching to cash flow, the company actually had less cash going out this quarter as compared to last year. The key here is that it is still less cash than they'd like. Oh, this brings up the big question. What are their plans to stop these losses? And more importantly, what are the company's main sources of cash? It might give us clues about what their future looks like. Well, right now they're really reliant on issuing more stock and warrants, things that give people the option to buy the stock in the future. That's how they're keeping the lights on, by raising more capital. They also took advantage of something called an at-the-market offering, where they slowly sell shares over time. That's another way they are bringing in cash without making a huge splash in the market all at once. Now, let's move on to something called restructuring charges. Basically, these are costs from changing up their company structure, which involves laying off some employees. Restructuring costs are up almost double from where they were last year, which makes me wonder if the management is running around clueless on what to do. Alright, let's talk about a big purchase they made, Pangiam. Last year there was a lot of activity related to buying this company, but this time around it's quiet, which suggests the deal is now bedded in. Pangiam added almost $11 million to revenue, but lost $4.1 million in new services for the quarter. The good news is it brought in millions in new revenue, but it's bad because it also brought in millions in additional loss. Quickly touching on accounting rule changes, there's something called ASU 2023-09 coming down the line. It's about how they report income taxes, but it probably won't shake things up too much for BigBear.ai. They actually had to fix some mistakes in their past reports regarding their convertible notes. These are like loans that can turn into stock. It just goes to show that even the best companies can mess up sometimes. It's not easy. Another thing to keep in mind is how they actually calculate the worth of companies they buy. I'm talking about things like goodwill and intangible assets. Goodwill is basically the extra amount you pay on top of the asset value for a company. And these numbers can change a lot. The initial value of net assets acquired was $55.2 million, as reported in their previous statements. Now, at the end of the year, that's revised down to $55.2 million, as reported in their previous statements. Now, at the end of the year, that's revised down to $55.4 million. See how even big numbers can change around and become really unpredictable. Speaking of goodwill, a good question that I have is why it is that they paid $156 million of it in the first place. All that value has disappeared now, which points to big issues in the future. Okay, digging deeper, let's talk about debt. They have got almost $143 million in debt, which is not good at all. To highlight a few values, the company owes about $17.7 million from something called 2002 to 2000. They also owe $124.6 million from what they call 2018 convertible notes. These are loans that can turn into stock someday. The problem with a lot of these values is that they are just moving things around and not really fixing the core issue. They need to be making profits. Let's look at something called derivative liabilities. They're basically bets on the value of their own stock. In the last 3 months, they've gone from being worth $170 million to just $57 million. Are these going to get better or worse? Your guess is as good as mine. Here's an interesting side note. They are currently fighting legal battles and they expect to lose around $7 million total. This kind of detail is interesting. Even though this particular value is low, it provides insights into how well the company is doing on the legal front. They also don't pay that much in taxes, and you know what they say, it's not what you make, it's what you keep. I see a bit of a concentration in their customers, with a few customers accounting for a pretty big chunk of their revenue. In the 3 months prior to today, their customer A accounted for about $6.5 million, and customers B, C, and D also take a big portion. I wonder if losing any of these contracts could leave a big hole in their revenues. And like a lot of companies, especially in their line of work, they're always at risk of the government changing its mind or policies, so they can't get too comfortable. BigBearai's says that their main priority is using AI to help people make decisions, and this market segment might be very profitable in the future due to all the advancement going on. I think if management were to come up with a plan that would really show how that's going to make money, then things would be a lot better. Also, management is saying they should have enough cash for the next year, which is good news, but they're less clear about what happens after that. But here is a little something to give you a scare. It looks like that even some of the leaders might quit to form their own thing and might even decide to compete with BigBear.ai in the future. As a shareholder, you have to be like, what is going on? Okay, here's the real talk. BigBear.ai looks like it's going through growing pains. The losses are concerning, and they really need to show how they're planning to make money down the road. They are relying on selling stock to keep going, which is a temporary solution, not a long-term strategy. If you invested here, I wouldn't start selling or anything, but keep your eyes wide open. Alright, that's our breakdown of BigBearai's latest filing. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.